If you open up your mortgage statement today and you thought, what the heck, why did my mortgage go up? Trust me, you're not alone.
When you are purchasing a new construction, you have to remember that the taxes have not been assessed.
So in the video you just saw, what this woman is saying doesn't make a lot of sense to me. I've helped numerous families buy new construction homes in the past 6 years, and I've never had a family or client come back to me and say, my taxes went up and they didn't include my taxes when I got my loan. But you do need to understand as a future homeowner what your taxes could be if you're buying land and putting a new house on it. So let's address the big pink elephant in the room and talk about our taxes. Now, this year in Cumberland County, where Fayetteville's at, in 2025, our taxes rose up 64%.
How much money was that?
So as a future possible homeowner buying a house in Cumberland County, what does this mean for you? A good possibility is that if you're looking to buy a house that's $250,000 and the taxes rose up 64% because it's not taken effect yet, depending on when you watch this video, your budget may change from about $250 to about $240 or $235. It really depends.
County sent out letters informing homeowners about the new value of their properties.
Per North Carolina law, every 8 years, municipalities and government agencies are required to take a look at the values of their homes and do a revaluation process.
Creating major concerns for families after seeing their property values nearly doubled. Worried about if this will increase their taxes in August. One person wrote on social media, "Dear Cumberland County, if you think my house is worth the amount you put on my tax reevaluation, then please buy it from me." Another person posted, "Cumberland County does not want to know what's on my mind right now." Feedback even prompting the chair of Cumberland County Board of Commissioners to post this Facebook video.
So new property values don't automatically mean higher taxes.
In North Carolina, taxes are assessed every 8 years. So the last time we had a tax assessment was 2017, pre-COVID. And of course, as you all know, as soon as the pandemic hit, interest rates dropped down to 2 to 3%. And we saw home prices skyrocket. To give you a good example, the house I live in now, me and my wife actually bought in 2016 for $172,000. It is now worth $280,000. So here's the deal. Wherever you may live, whether it be North Carolina or another state, and I don't know the states and every other laws, but in North Carolina, you will be taxed on the land. But once you put a house there, they're going to appraise the house, and now you're being taxed on the house and the land together. And that tax assessed value is based on what they think your house is worth. Now, sometimes the tax value is lower than what your house could actually sell for. For instance, at the time of you watching this video, I'm only being taxed my house maybe worth about $200,000. Now it's going to be worth $280,000, possibly or higher. And again, like I said earlier, they assess our taxes every 8 years. So in another 8 years, it's going to go up again.
Means your tax revenue will go way up.
But this is where it gets a little tricky and spicy. Now, when you get a loan, you have an escrow account. Your escrow account includes your insurance and your taxes. And your taxes can go up, so could your insurance if you change insurance companies, or it could also go down if you change insurance companies. This is all part of your escrow account. So at the end of the year, you may have some money left over. Like a couple years ago, me and my wife had some money left over in our escrow account. And they wrote us a check at the end of the year. I've seen some people where they had to pay extra money at the end of the year. Because if your taxes were to rise this year in 2025, and it's going to take effect in June, they will say it will take effect in June for the end of the year, then what's going to happen is my escrow account is going to shrink even more and more and more to where eventually there's no money there and they're going to have to charge me for the difference. Now the following year, it'll all get caught back up. So next thing we talk about is market value is different from tax value. And I remember what I said earlier, tax value is what they assess your property may be worth. Market value is what your property could sell for. So again, I said earlier, your tax value is typically lower than your market value. So let's say you own a house and you think I think I do a market analysis for you, and I think it could sell for, we'll say, $300,000. Your tax value on your house may be about $280,000 or $290,000. Of course, this year it could be a little different. Now, market value depends on location, upgrades, comps, and supply and demand. Like right now, we are in still a seller's market in my area. That means we have more buyers than we have homes. So supply and demand. Another thing that could affect it also are those interest rates. Now, this does not directly affect your taxes, but if the county gets bold and thinks the market is hot, they may start creeping up that tax value. So why does this all matter? Now, this is going to deal with more with new construction, so definitely buyers pay attention to this part.
This is important.
So the next thing I'm talking about is going to be why this matters to you, and this typically pertains to new construction. So definitely, if you are thinking about buying new construction, this video is for you. So if you close on a brand new house, let's say you find the land, and let's say you paid $20,000 for the land, just good old, easy math. You're only paying taxes on that land. And now let's say you bring a builder in, and now you want to build a $500,000 home on this $20,000 land. Obviously, your land and your property is going to get taxed on, because essentially you were just paying on the land. Now, of course, this does not take effect until your house is complete. They do an appraisal on your house, see what it's worth. Then the county will tax you on that. That should not be a surprise to you. If you really thought you were only going to have to pay taxes on the land and not that house, you're in for a big shocker there. So this also goes for new builds too. So let's say you're looking to purchase a new build house. Builders already got lots all lined up, but the lots don't have any houses on them yet. And you want that certain lot. Yeah, you want that lot, and you want that house on that lot. So right now the builder's only paying for the lot, which is really cheap. He builds a house up. The house is ready in about 4 to 5 months. And then you get your house appraised. Now, let's say the house costs $500,000 again, just for good sake of math, easy math. Now, of course, your PITI, which is your principal, interest, taxes, and insurance, are going to go up because now your house appraised for $500,000 plus the land.
That makes sense.
In that video I showed you earlier, I don't know the whole video, and I don't know the whole background of the story, so I can only guess. But I find it hard to believe that they only taxed her on the land, and I don't know what video was taken at again, and that was it. Because I helped plenty of families buy new construction homes, and the lender has always said, okay, we do an appraisal on the house. Hey, the house appraised for this much. Your mortgage payments are going to be this much because we think your tax value is going to be this much. Now, of course, they don't know the tax value to the end of the year, but they have a good idea of what your taxes may be. That same house you picked was probably just built 2 streets over, or even maybe 2 miles down the street. So they have an idea of what your tax value is going to be. So here's another example. In North Carolina, we always have an attorney that closes on your house. So the attorney is going to call the tax office to find out what your taxes may assess for. And this is just an estimation. Your house may be worth, if your house is worth $500,000, they're probably going to tell the tax office, hey, this house is worth $500,000. Give me what the taxes may be on this house that's worth $500,000. Oh yeah, plus the land is worth another, well, if it's a new build, that's already added in. But let's say the lot costs another $10,000. So they add that all into your PITI.
You keep using that word. I don't think it means what you think it means.
So property taxes for new construction homes are typically calculated in 2 phases. Initial assessment, when you first purchase a property, you're only paying taxes on the value of the land. This is because the structure hasn't been completed yet. The final assessment is once the home is completed and a certificate of occupancy is issued, the local tax authority will assess the property to include the value of the structure. This assessment usually occurs within a few months of moving in. So that video was a little confusing because I don't know the whole story to it, especially when she said that shiny new house is plopped on and then you're getting taxed on it like it's a big shocker, which I find really hard to believe and understand. Now I'm going to show you a little formula quickly that the county may use to assess your taxes. So what they do, they take to assess value of the property times it the local tax rate equals annual property taxes. For new construction home, mortgage lenders often estimate property taxes based on the anticipated complete value of the home. They typically use a rate of 1.25% or 1.5% of the purchase price to calculate the annual tax premium for qualification purposes. This estimate is used to determine your monthly mortgage payments, which include contributions to an escrow agent for future tax payments. And here's another note. It's important to know that your initial tax payments may be lower, reflecting only the land value. However, you should expect a significant increase, possibly 2 to 3 times higher, once the home value is factored into the assessment. This increase usually occurs in the second year of ownership. Just remember, your actual tax value property may be different from what estimate they gave you initially. Remember, it's an estimate. So it's definitely wise to prepare for more taxes. So set some money aside, be prepared for this. And just another pro tip here, definitely if you're buying new construction, look at your closing statements. Get with your lender, your attorney, both, your realtor, all three, and to make sure you're getting taxed accurately for that. And I know, again, it's an estimate, but you want to be prepared. So at least you can have money set aside because it may be higher. And if that extra money is used or not used or a little bit is used, the good, if you saved up a bunch of money, you don't need to use it, fantastic. But at least you have that safety net there for you.
Better to have it and not need it than to need it and not have it.
Next thing I'll talk about is why your mortgage payment went up or may go up. First thing is going to be your escrow adjustments. Like I said earlier, your escrow adjustments is your PITI, which is your principal, interest, taxes, and insurance. Your taxes and your insurance can go up and go down. And if it goes up and you run out of money in your escrow account, they're going to charge you at the end of the year. And that's part of your mortgage payment. So every month your lender is going to collect that extra. And if it goes up, they're going to take more from you. And again, earlier, like I said, Cumberland County taxes went up almost 64 to 65% for some people. And that escrow account definitely got wiped out very quickly. We'll find out in June. I'll find out in June. All of us will. If our taxes did go up, because I did appeal my house. They said it was worth $294. I says worth $280. We'll see what happens. Next thing that affects your mortgage adjustment is going to be your PMI or your MIP. So your PMI typically is with your conventional loans. If you didn't put out 20%, you got PMI. And that PMI can fall off after you've paid the 20%. So like for instance, me and my wife, we have owned this house for about almost 9 years now that we lived in. And the PMI just got dropped off just actually a few months ago. So we've met that 20% ratio and the PMI dropped off, thank God, because it was about another $150, $200 every month we had to pay. And then you got the FHA loan, which has the MPI. And unfortunately, MPI is for life. It stays with the FHA loan forever. And it's kind of like the PMI. And now to go back to your PMI, not to confuse everybody, because MPI, MIP,
It's so confusing.
it's all making me a little crazy myself. But definitely make sure your PMI falls off at 20%. Maybe want to call your lender because sometimes it does not happen automatically. And I know we've been hitting on this a lot, but your insurance may go up. If you switch insurance companies, if you made a claims adjustment and you paid a deductible, let's say for a new roof or whatever the case may be, your insurance goes up, your escrow is going to go up. You have to pay a little more. That's maybe another reason why your mortgage payment went up, because of your PITI. Definitely shop around for your insurance companies. There's thousands of companies out there. I definitely take recommendations from your lender, from your realtor, because they're here locally. They should be, at least your realtor is, and they know who you should reach out to. I deal a lot with military families, and they have USAA, so USAA is a good choice for families also. Another reason why your mortgage payment went up is if you got an ARM rate instead of a fixed rate. Now, the difference between these two is this. The fixed rate, for instance, I have a fixed rate, my wife do. Our fixed rate is, I think, 5 1/4. So that's our interest rate forever, unless we refinance or we change it to an ARM rate, which we'll never do. An ARM rate fluctuates and go up and go down. So an adjustable rate really depends on your situation. Definitely talk about it with your lender or your loan officer or bank or whoever you get a loan from. But ARM rates can be good. I've helped a lot of families get ARM rates where they will start off at say 5%, and it's 5% interest. It'll be 5% for the next 5 years. And of course, one of the couples I'm talking about, they said before the 5 years is up, if interest rates have dropped, they're going to switch it to a fixed rate. So that's one option you can do. With an ARM rate, I believe they can only go up so much. So let's say they went from 5% to, they can only jump up 1 or 2%, I believe. Definitely talk to a lender about that. I'm not sure because I'm not a lender, but they can only go so high. So it's not like they can go from 5% to like 10%, I don't believe. That'd be super outrageous and you would end up being foreclosed on. So, but be careful of ARM rates. And if you do get one, and just know when it expires to expect that rate change if you're going to keep it. So now I'm going to give you 10 ways to lower your mortgage payments. Number 1, refinance to a lower rate. Only this makes sense after closing. Boost your credit score. Better credit equals better deals. Put more money down, less borrowed, less paid. Extend the loan term, lower payments, longer payoff. Remove your PMI, like I said earlier, at 80% for PMI. Oh, and I'm mistaken. I guess I thought MPI was forever, but I thought MIP was forever. But after 11 years, for FHA can fall off. So that's good. Buy down your rates. You can buy down points. Definitely save you some more money. Now that would cost money up front, but if you've got it, talk to your lender. Definitely see if buy down points would be a good thing for you. What I have seen happen a lot is people buy down points and then they talk about refinance in a year or two, and that kind of hurts them. So definitely talk to your lender about buying down points. It could help you or hurt you depending on what your future, plans may be with your mortgage. And again, we're just hit on again, but shop around for insurance, check with different companies. Again, we just talked about it. ARM rates, make sure they fit you and fit your budget. And again, I'd only get it if you're going to refinance in a couple of years or change it to a fixed rate. Make extra payments, and you're probably asking, how do you do that, or can you do that? Me and my wife, we pay our mortgage twice a month. Our bill is I can't remember what our mortgage is, but we pay the first of the month we pay half it, and in the middle of the month we pay half of it. And you're probably thinking, who cares? But there are a few months that are 5 weeks. So if we make an extra payment, the taxes are not included. I'm sorry, the insurance is not included, not the taxes. The rates are not included. We're just paying your principal. So at the end of the year, we actually made an extra payment or two possibly. So doesn't sound like much, but over a 30-year mortgage, that is a lot. Next thing you do is recast your mortgage. Lump sum it and then recalculate it to a lower payment. So buying a house can be scary. I'm not going to act like it's not. Definitely make sure you find the right lender, the right realtor. If you're looking to move to my area, please reach out to me. I'd love to help you. Remember, just take all this advice in consideration, especially if you're buying a new construction or if you're having a house built on some land you just bought. And just remember, North Carolina taxes go up every 8 years. They assess it every years. Sometimes they may do a special assessment and do it every 4 years. You just never know. Take all that consideration when you're paying your taxes. And if you're thinking of moving to Fayetteville or the surrounding areas, please reach out to the team and me. We would love to help you. My direct number is below. You can call or text me there, or you can scan this QR code up here in the corner and set up a time on my calendar. And definitely check out these other videos that YouTube recommends to you, and I'll see you guys in the next video.